Welcome to Calm Investors. I am Ruth.
And I am Patrick, and today we are starting something new.
This is Season 1, The Psychology of Wealth in Season 0. We built the financial foundation, debt plans, emergency funds, savings habits, all of that. But now we need to talk about something that trips up even the smartest investors.
Your own brain.
Your own brain, and Patrick, I think you have a perfect example of this.
Oh, I do so, Ruth. I have been looking at my 401k since we finished Season 0, and I keep checking it every day. The market dropped 2% last Tuesday, and I almost moved everything to cash, I had the app open, my finger was on the button. Please tell me I am not the only one.
You are absolutely not the only one. And the fact that you are admitting this is actually really important, because what you just described, that urge to panic and move to cash when the market dips, that is the single most expensive mistake investors make. And I do not mean expensive like, oh, you missed out on a little bit of return. I mean, it is the reason most investors fail.
Wait, most investors fail?
Most investors dramatically underperform the market, and there is hard data on this. There is a company called DALBAR that has been studying investor behavior for over 30 years. Every year they publish a report comparing what the stock market actually returned versus what the average investor actually earned, and the gap is staggering.
Okay, give me the numbers.
Over the past 30 years, the S&P 500 has returned roughly 10% per year on average. That is the market return. If you had just bought an index fund and done absolutely nothing, no checking, no trading, no panicking, you would have earned about 10% per year. But the average equity investor over that same period earned about 3.5%, 3.5 out of 10.
That is barely a third. How is that possible? Are people picking terrible stocks?
That is the thing. It is not about stock picking. It is not about bad funds or high fees, although those matter too. The gap, and this is the important part. The gap is almost entirely behavioral. It is about when people buy and when people sell. They buy when the market is going up because it feels safe. And they sell when the market is going down because it feels dangerous. They buy high and sell low, over and over and over again.
Buy high, sell low. That is literally the opposite of what you are supposed to do.
It is the exact opposite, and yet it is what the majority of investors do because their brains are telling them to. And this is not a character flaw, Patrick. This is evolution.
What do you mean, evolution?
So your brain evolved to keep you alive on the savannah. And on the savannah, if everyone around you started running, you ran too. You did not stop to analyze the situation. You did not pull up a chart. You ran because the cost of running when there was no lion was low, but the cost of not running when there was a lion was death. So your brain developed a very strong bias toward avoiding loss and following the crowd.
Okay, so that instinct kept our ancestors alive.
It absolutely did. But in investing, that instinct is the enemy. Because in investing, the lion is not real. The market drops 2% and your brain screams danger. Run, sell everything. But the danger is not the drop. The danger is your reaction to the drop. And this brings us to the 3 brain traps that cause the behavior gap.
Okay, 3 brain traps. Let us hear them.
Number 1, loss aversion. This is the big one. Research by Daniel Kahneman and Amos Tversky, they won the Nobel Prize for this, shows that losing money feels roughly twice as painful as gaining the same amount feels good. So if you gain $100, that feels nice. But if you lose $100, that feels terrible, disproportionately terrible. And that asymmetry drives people to sell at the worst possible time, just to make the pain stop.
That is exactly what I felt last Tuesday. The pain of watching it go down was so much worse than the pleasure of watching it go up the week before.
Exactly. Number 2. Herd mentality. When everyone around you is panicking, your brain says they must know something I do not. I should panic too. And when everyone is buying, your brain says, I am missing out. I need to get in. You follow the crowd not because you are dumb, but because your brain is wired to assume the crowd has information you do not.
Oh, I have definitely felt that one too. When my coworkers are all talking about how the market is crashing, it is really hard not to feel like I should do something.
And number 3, recency bias. This is the tendency to assume that whatever is happening right now will continue happening forever. If the market has been going up for 6 months, your brain assumes it will keep going up. If it has been dropping for 2 weeks, your brain assumes it will keep dropping. You project the recent past into the infinite future, and that leads to terrible timing decisions.
Okay, so loss aversion makes you panic, herd mentality makes you follow the crowd, and recency bias makes you assume the trend will last forever. Those 3 together, that is a recipe for disaster.
It is. And when you combine all 3, you get what I call the emotional cycle of investing. And this cycle has played out in every single market crash in history. It goes like this. The market starts dropping. You feel fear. The drop continues. Fear turns to panic. Panic leads to selling. You sell at or near the bottom. Then the market recovers. Because it always recovers, and you miss the recovery. Then you feel regret, and eventually, when the market is back at all-time highs and it feels safe again, you buy back in at the top, and the cycle starts over.
Fear, panic, sell, miss the recovery, regret, buy back in at the top. That is brutal.
It is brutal, and it is exactly what happened in 2008. Let me walk you through it.
Yeah, I was pretty young during 2008, but I remember my parents being stressed about money.
So, in 2008, the financial crisis hit. The S&P 500 dropped about 57% from its peak. 57%. If you had $100,000 invested, you were looking at $43,000, and the headlines were apocalyptic. Banks failing, Lehman Brothers collapsing. People were genuinely afraid the entire financial system was going to fall apart.
And people sold.
Millions of people sold. They moved to cash. They moved to bonds. They got out. And here's what happened next. The market bottomed in March 2009. And from that bottom, it went on one of the greatest bull runs in history. Within 5 years. It had fully recovered within 10 years. It had more than tripled. The people who stayed in, who did nothing, were rewarded enormously. The people who sold at the bottom locked in their losses and missed the recovery.
And then the same thing happened in 2020, right?
Almost identical. COVID hit in March 2020. The market dropped 34% in about 5 weeks. Fastest crash in history. The fear was real. The world was shutting down. Nobody knew what was going to happen, and millions of investors sold. They could not take the pain, but the market bottomed on March 23, 2020, and by August, 5 months later, it was back to all-time highs. 5 months. The people who panic sold in March and waited for things to feel safe missed one of the fastest recoveries ever recorded.
Same pattern, same emotional cycle, same result.
Every single time. And this is the key insight, Patrick. The pattern does not change because the brain does not change. The circumstances are different every time. A financial crisis, a pandemic, a war, an inflation scare. But the emotional cycle is identical. Fear, panic, sell, miss the recovery, regret.
But what if the market really is crashing this time? Like, how do you know it is going to recover? What if this time is different?
That is the question everyone asks, and it is a fair question. But here is what the data tells us in the entire history of the U.S. stock market. Going back over 100 years, every single crash has been followed by a recovery. Every one, the Great Depression, World War II, the oil crisis, Black Monday, the dot-com bust, 2008, COVID. Every single time, the market came back and eventually reached new highs. Now, does that guarantee the future? No, nothing guarantees the future, but 100 years of data is a pretty strong argument for patience.
Okay, so the data says stay the course, but my brain is screaming at me to do something. How do I actually fight that?
And this is the most important thing I am going to say today. The fix is not more information. It is not reading more articles. It is not watching more financial news. In fact, more information often makes it worse because it gives your brain more fuel for panic. The fix is a philosophy, a set of rules you decide on before the crisis hits. When you are calm, when you are rational, when the market is boring and nothing is happening, that is when you make your plan.
A philosophy decided before the crisis, not during it.
Exactly, because during the crisis, your rational brain goes offline, the emotional brain takes over, and the emotional brain is terrible at investing. So you need a plan that was made by your rational brain, written down, that you can follow even when every instinct is telling you to do the opposite.
Okay, so what does that actually look like? Practically?
Here is your first piece of emotional armor, and I want everyone listening to do this. Get a piece of paper or open the Notes app on your phone and write this sentence. If my portfolio drops 50% tomorrow, I will blank. Fill in the blank, maybe it is. I will do nothing and keep investing on schedule. Maybe it is, I will rebalance according to my plan. Maybe it is, I will call my financial advisor before making any changes. Whatever it is, write it down and keep it somewhere you can find it during the next market drop.
I love that, because when the panic hits, you do not have to think, you just follow the plan you already made.
That is exactly right. The best investors in the world are not smarter than you. They are not better at predicting the market. They just have systems that protect them from their own emotions. Warren Buffett has said it 100 times. The stock market is a device for transferring money from the impatient to the patient. That is it. Patience is the edge. Not intelligence, not information, patience.
From the impatient to the patient, that is a powerful way to think about it.
It is, and that is what this entire season is about. We are going to build your psychological armor, one piece at a time, so that when the next crash comes, and it will come, you are ready. Not because you predicted it, but because you prepared for it.
All right, let us lock in the key takeaways from today.
Number 1. The average investor earns roughly 1/3 of what the market returns. The gap is not about knowledge or stock picking. It is entirely behavioral. Number 2. Your brain is wired to buy high when it feels safe and sell low when it feels dangerous. That is the exact opposite of what builds wealth. It is not a character flaw. It is evolution. Number 3. The fix is not more market knowledge. It is a pre-committed philosophy, a set of rules you decide on before emotions are involved. And number 4. Every major crash in history has been followed by a recovery that rewarded those who stayed the course. The pattern has not changed in over 100 years.
And your homework, write down what you will do if your portfolio drops 50%. That is your first piece of emotional armor. Keep it somewhere you can find it.
That is it for today. If this episode made you think about your own investing behavior, follow Calm Investors wherever you are listening. Share this with someone who needs to hear it.
Thanks for listening, everyone.
Stay calm, build wealth,